back. You're watching The Money Show, and it's time to get your mutual fund portfolio queries answered live. And as an expert, today I'm joined by Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Shweta, hi, good evening, and welcome to the show. And let's quickly begin our viewer queries today. We will take Saiba's question first. She says that I would like to know my investment model is correct. She is an NRI, age 44, aggressive investor, time horizon 15 years. She has 50 lakhs from her savings and she wants to invest. She already started doing SIP and 5 funds for a year. Access Small Cap, Canara Beco Small Cap. She's got Access Growth Opportunity, Parag Parikh Flexi Cap, Parag Parikh Tax Saving also. She wants you to review her mutual fund portfolio. Shweta.
Sure. Hi, Sai. I'll just say while what's important for you, first steps, I'm sure you would have considered this, but have your goal in place, have your asset allocation in place, considering that you're aggressive and you have a longer term horizon. I'd say you can have around 75 to 80% in equity and residual in debt, right? That's broadly the asset allocation you can follow. Coming down to your schemes, see, if you I'm considering this is only the equity component of your portfolio and advising you accordingly. So if these are the schemes that you're looking at, coming down to the schemes, I would say the two Access schemes that you've shortlisted, Access Growth and Access Small Cap, is something that you can avoid. There is another, Parag Parikh ELSS scheme that you said, that is again something avoidable. You already have a flexi cap. There'll be same fund manager there. Instead of these, what I suggest is, you go in for certain differentiated styles or investment themes in your portfolio. So you can consider adding an ICICI Pru dividend yield, add in an SBI Contra fund, go in for a Kotak multi-cap. In case you need ELSS, right? Because that's generally done from an ATC investing purpose. If you need that, it'll have a 3-year lock-in. You can go in for an HDFC ELSS scheme. Roughly, if you go with this combination, you will get a good spread across asset management companies, across different styles, and a good market cap blend is what you will get from this basket.
Shweta, also SEBI is an NRI. Anything in specific that you would want to advise as an NRI investor?
Yeah. So I'm not too sure whether she's a US based NRI or, NRI based out of some other country. If she's a US based NRI, then you will have some restrictions. Some asset management companies would not take your investments, but considering the AMCs that you've chosen, I'm assuming you're not a US NRI. So there are no restrictions. If you are let's say a UAE or a Singapore based NRI, then you should take into account that there is a double tax avoidance treaty. So, you would not be taxed in India as well as your resident country if you have a TRC in place. Plus, with the new, budget announcement, the good news for an NRI is that the 20% TDS deduction that AMCs would do when you would redeem funds now will not happen for you. So that I think is one positive. But DTAA is a good, an important point. You should take that into note when you're doing your investments.
All right, Shweta, let's move on to Utej's question. And Utej says that he's 29 years old, wants to invest almost 30 lakhs in mutual funds, and he wants to know which is the right category for him. And he's considering Nippon multi-cap, quant mid-cap, and investment horizon is actually 3 to 5 years. So low risk appetite, it seems. But congratulations, 29 years and already looking at having an investment strategy for a corpus of 30 lakhs that he wants to invest. Shweta.
Absolutely, Utesh. This is a very good step, that you've taken towards investing. And yeah, since you have a 3 to 5 year horizon, you have a low risk appetite, what you said. So keep in mind what asset allocation you're doing. I'm assuming this is again only the equity component of your portfolio, but being 30 years, you have a longer term horizon, you can have an equity heavy portfolio. Now, since, what I would suggest is Nippon Multicap is a good fund. You can continue with that. Apart from that, I would suggest you construct a basket which has 5 to 6 schemes. It will help you diversify and therefore, in a way, lower down your overall risk, spread it across large cap, mid cap, small cap with 50 to 55% of your portfolio being large cap. So that again will bring down the risk component of the overall portfolio. I'm just going to mention some schemes that you can use to build your portfolio. Instead of a quant mid cap, go in for a quant large cap fund. You can have an ICICI Pru focus equity fund, have a Kotak emerging fund in your portfolio, right? You go in for one HDFC small cap and an SBI infrastructure, along with the Nippon multi cap. So 6 schemes you can start with to have your portfolio in.
What about the risk around, involved over here? Because I think the time frame is 3 to 5 years. Do you think for that, I mean, having a sector specific and exposure in small cap would be good, or you want him to have slightly more risk averse portfolio?
So, the infrastructure fund that I also mentioned actually is spread across. It has 8 sector exposures. It's well diversified. The top holding would not be more than 8-9%. So it's not really a sector play. So it's not like a pharma sector. It is well spread out across sectors. It's like a quasi diversified, which would benefit if infra plays out. But even if that doesn't happen, the scheme would still do well, which is where that recommendation. So it's not purely a sector call. Second, coming to small cap, see, he did mention 3 to 5 years of investing horizon, and the basket I recommended would not have more than 20-25% of small cap in the portfolio. And given where we stand in terms of earnings expectation from the small cap segment, where the liquidity flow is going today, and also valuations, taking all these 3 points into consideration, it may still make sense to have a little bit of small cap in your portfolio. So overall, technically the way we look at risk is beta, or how volatile are you compared to a certain benchmark. With this combination, he'll get exposure to around 150-170 underlying stocks, and that would help him bring down the overall risk of the portfolio.
All right. Let's take Kartika's question. And Kartika says that she's 30 years old working woman, and she recently sold a plot, invested 70% of it in mutual funds and kept the rest in bank fixed deposit. She's recently invested lump sum into 5 mutual funds. Initially had plans to invest in open-ended funds, but since due to lack of discipline, she had to switch the funds to into a lock-in period. The target is to reach 100 CR in 10 years. I need to know if it's possible by this kind of investment, and she's ready to hold on to 2 retirement funds for 20 years. Now, she says that she has Quant ELSS tax saver, Parag Parekh ELSS, Kero Rebecco tax saver, HDFC retirement savings fund, and ICICI retirement fund. And she will not be able to do anything more with the investments, and she can leave the investments as it is for 10 years for the first 3, and 20 years for the last 2. And after that, she wishes to start her own cafe, and she requires 15 CRs for that. And she would also like to know when should she start, I mean, if she needs to switch her funds into a safer instrument when she's coming closer to the financial goal. Interesting question. I wish we really had Kartika on the phone line, but she has a goal, and she's also moved towards achieving it. But then let's look at the strategy. All right. What she should move and where, Shweta?
Yeah. So Kartika, I'm just gonna list down the good things that you've done for the portfolio. You sold the real estate and you've invested into equity. That's a good decision. You have a goal in mind and you're heading towards that. That again is a good thing. Third, you've done your asset allocation, and given that you have a 10-year horizon, you're pretty much right with your asset allocation, where you're going 70% equity, 30% debt. For the instrument that you've chosen, which is equity mutual funds, is again right. Because you did mention that you don't have investment discipline. I'm sure you're not tracking the markets that closely. So, that again, the vehicle chosen is good. So I'm going to congratulate you for a lot of those right decisions you've taken. Something that I would say, can be avoided is to have close-ended funds in the portfolio. because one, it doesn't allow you to rebalance the portfolio if required. If anything is going wrong with the scheme, if there's a better opportunity available, you'll not be able to do make those switches. Third, you are compromising on your liquidity. And to compromise on that liquidity, it's not that you're going to get any extra return for doing that, right? So even for going forward perspective, I would suggest don't invest in close-ended funds. Coming to the schemes that you have, see the ELSS, you can exit after 3 years. Retirement savings fund, you can exit after 5 years. So I would suggest you to do that once the exit load period is, the lock-in period is over for you, right? So you can, retain maybe a Canara ELSS, you can retain one of the retirement savings fund, and the rest, I would suggest at that point of time, you go in open-ended schemes. Yeah. Coming to your last question of when should you switch? See, 38 crores is what you have invested in equity mutual funds. Given the longer term track record, you can expect around a 12-13% over a longer time period. So this corpus, you will get to around 115, 116 crores. So you're well in line to achieve your target. What I would recommend is 2 years before you're nearing the goal, that much portion that you need. So 15 crores is what you need. At the end of 8 years, you can switch out that 15 crores and move into safer instruments, like, you can go in for debt funds or any debt based instrument, so that money is safeguarded, because you're going to need it for your
You need
goal.
to protect your capital as well as your profit that you have gained from your investments. Thank you so much. It's time up on the show today. Shweta, thank you for being on the show and helping our viewers with their queries. And before I sign off, I'm going to leave you with our WhatsApp number and email ID so that you keep sending your questions. Thank you so much for watching. Goodbye.